So you want to know what exactly is happening in the real estate market and how is it impacting housing? Well, stick around because we'll cover the three questions we're being asked right now, which is will mortgage rates keep rising? What's going to happen with home values? And the shining star, which really is what is going on with the equity in my home. Thanks for sticking around. And today's market update is one of the most important updates as we look at closing out quarter three and so much change that has obviously impacted the housing market and overall, though, the headline market and the messaging that we're receiving. So let's kick off with a quote from Mark Fleming. When the economic uncertainty dust settles, those buyers and sellers who were on the sideline will jump back in the housing game. Demographic trends support elevated purchase demand in the years to come. So it's a question of when, not if, for the housing market. And what this means is that for most people, which may be similar to you, the question is when should we continue with the thoughts that we had over the last year? And in times of uncertainty, people follow the certain. And that's what I want to give you in your national housing update versus what you're getting, which is the uncertainty, not that it's wrong, but due to the fact that it is not related to your specific situation or market, the headlines continue to do more to harm or hurt than help. So let's dive right into, will mortgage rates keep rising? And as we answer this question, you'll see the headlines continue to share exactly what is happening, but in a way that creates fear. And we'll talk about why in times of certainty, if situations or steps align with what we want to see happen, that is a good sign. Whereas unfortunately, when you see headlines like the U.S. housing market stares down an even bigger economic shock, mortgage rates near 7%, the challenge with all of this is the headlines are not inaccurate. The mortgage rates are reaching very high levels compared to where they've been over the last 10 to 12 to 15 years. But if we look back on the last 30, many people have already heard and known that those percentages are lower. But the price of homes are much greater. And so as you look at this next slide here, what you're seeing is that we've continued to see continued climb in interest rates over the last 6 weeks. And this does not include, because it's the end of September, most of you are getting this report towards the latter of the month of October. And so we've continued to see mortgage rates rise for another 3 to 4 weeks. And as we look at, well, what is going on in the housing market and why we're going to continue to see them rise. Now, is that 100% a fact? Not necessarily, but quite a high prediction if we look at what we're trying to accomplish in slowing down inflation. So as you look at the continued rise in rates, not just for 6 consecutive weeks, but for now about 9 going on 10, you can see the uncertainty and volatility in financial markets is heavily impacting mortgage rates. So this is where we time out, slow down, and actually look at, are the right steps being taken, and can we predict most likely what will continue to happen in a favorable way? Affordability or making homes less affordable is not favorable to many of us, but understand, as you look at the deputy chief economist and his quote here, the aim of Fed tightening is to curtail demand in an effort to tame inflation. And when it comes to the housing market, the Fed's actions are working. When you look at the rate of appreciation increasing in housing since COVID and really over the last 5 years, one of the greatest sources or areas of inflation was the housing market. Now, nobody wants the negative impact of rising rates and what that leads to affordability. But look here, as it shows, home sales, both new and existing, are falling. Builders have cut back production in response to rapidly declining affordability, and annual house price growth has slowed down from the peak of nearly 21% in March of this year to 16% in July. And as you look at these numbers come November, Q3, that number will have decreased even more, which is doing exactly what we needed to see happen to support slowing down the rate of inflation. Now, remember, we received so many benefits in the housing market in the form of appreciation. But the challenge with that is for many people, it impacted their ability to enter the market. And we're going to cover again a little bit more around home prices here in a moment. But I just want you to find certainty and confidence that even though it's taken us longer to slow down inflation, rising rates are doing exactly what they needed to do, just maybe a little bit longer than we would have liked, which is slow down the rate of appreciating housing. Now, we also want to know, though, does that mean that home prices will go down? Because that's really what is on everybody's mind. As you can see here from Realtor.com, well, even 2 months ago, rates above 7% may have seemed unthinkable. At the current pace, we expect rates to surpass that level in the next 3 months. What this is sharing is buckle up, because Q4 is going to have a lot of challenge when it comes to rates. And then that will lead, yes, to the question of affordability. But remember, we have to look at affordability in a comparison of the cost of not owning a home as well, which we'll cover. So as you can see here from Realtor.com, there's no doubt that the increasing mortgage rate will make home buying even more challenging. Buyers may still find opportunities as these changes coincide with the time of the year when buyers have historically found the best market conditions to obtain more bargaining power. Now, remember, as you look at, yes, this time seasonality wise usually leads to buyers seeing more bargaining power, and it's actually happening again. So as we see less demand in the market, the homes that do come on the market, people have more ability to bargain their way through the challenges or constraints of affordability. And there's really 3 key factors here. One is that you have to remember paying $800 more a month in rent for a period of time is also looking at comparing to the $80,000 you needed for a down payment or covering an appraisal or the gap between it when you were competing at the beginning of this year. So there is a difference in what you had to have compared to what it costs now. And some of these things are just more short-term pains for those who didn't over long-term have the ability to compete in the housing market at the beginning of the year. The other part is you start looking at is that each lender, and there are a lot of mortgage providers out there who have more programs outside of just the standard programs we are all accustomed to help people with that affordability. Now, remember, you want to make sure that you purchase a home you love and that you can afford. But there is creative financing to make it more affordable for periods of time. And if people have not shared that with you, definitely reach out, because there's ways to have sellers provide you a lower interest rate for a period of time because they want to see their home sold, and it's actually a win-win situation for both parties. But let's keep moving forward as we look at then Mark Fleming. He's saying while mortgage rates are expected to continue to drift higher over the coming months, much of the rapid increase in rates is likely behind us. Nationally, while month-over-month home prices may decline, annual house price declines are not expected, given the ongoing supply demand imbalance and continued strength in the labor market. So let's cover what is going to happen with prices. We know we're not going to see major increases because we've gone from the low 3s all the way up to upward to 8% over a short period of time. But we are going to make sure that mortgage rates continue to climb to slow down inflation. But also remember, what sector brings us out of a recession is the lowering of mortgage rates, because housing is one of the best ways to come out of a recessionary period. So let's dive into what exactly is ahead for home prices. I'm going to give you the good, the bad, the ugly, and really the worst case scenarios. So that way many of us can prepare. And if we have any better cases or scenarios, which almost 86% of the top experts are predicting, is that we just come out ahead. But no matter what, you're not taken by surprise, which is what most of us can handle, is knowing what's going to happen, but not being surprised by it. So the root issue of what drives house prices almost always is supply and demand. So remember that when we look at the period and what type of market we're in, we're still in a nation, and obviously locally here in Colorado, in a seller's market, which a neutral market is 4 months of inventory or less. We're still lower than 2%, 2 months of inventory here in Colorado, and a little over 3 in the nation. So as you look at supply and demand that quickly changed, year over year comparisons, remember, showings are down 12%, and we have 30% more listings active on the market, meaning available. We know that that was nothing like it is now compared to where it was a year ago. And so what are the experts are saying is going to happen with this current change that's happened quickly due to what we needed to see with the rise of mortgage rates is Ivy Zellman, who's somebody we like to report to. She is the one expert that is predicting that we're going to see home prices fall. So this really is taking into account the worst case scenario. So that way many of you could factor into how's that compare with my current situation. And remember, if you own a home, we've received so much equity gain over the last 5 years that sometimes the market has to take back a little bit of what it gave. But at the end of the day, if that was only giving back 9% over the next 2 years, every single one of us homeowners are coming out in a very good situation of where our current equity would be and loan to value of homes, which is very, very low. And I'll talk about that here in a moment. So as you look at her predictions of 4% home prices depreciating and 5% in 2024, you can start looking at the math on this and just assume that you're in a $40,000 decrease of value because you have a $400,000 home that you purchased. Is, well, if you're paying $3,000 in a month in rent, $36,000 a year is already covered due to the fact that you're currently a renter, which just goes back to every situation is a little different. If you're a current homeowner or you're a renter, there's different values proposed to why you would make a change in the current situation. Now, as you start looking at the senior economists at Realtor.com, not surprisingly, deals are not getting done, with sales of new and existing homes declining for over half a year, given that demand is cooling due to high borrowing costs, incomes falling behind inflation, the still limited supply pipeline is becoming increasingly clear that prices have to decline to restore market liquidity and balance. And so what is he saying is that he's expecting prices to decline, but not depreciate. Now, as you also look at First American's chief economist, while the market's considered overvalued, may need to adjust the not so new reality of higher mortgage rates, housing market fundamentals still support a moderation of annualized house price appreciation rather than a sharp decline. So what do they all mean by this? Well, let's look at the hedge fund manager who called the 2008 crisis. We are not at risk of a collapse today in the financial system like we were before. It's true. Housing may be a little frothy, so housing prices may come down or they may plateau, but not to the extent it happened. This is the most important part for most people, which is we just want to know, are we in any situation like we've been in the past, and help advise me as to how does this impact my current situation. And as we were sharing, it's different if you're a renter and much different if you're a current homeowner. Waiting has a different consequence. 2023 home price forecast. Now let's actually look at the exact numbers. So as you take the 6 or the average of all of their forecasts, you can see best case scenario, the nation's thinking about 2% increase in appreciation next year, which let's just call that flat. Now, as you look at Colorado, we're usually double that of what the nation's averages are. So we could call it 4% here, which is a lot on an average median home value upwards to over $650,000. But even if you're looking at Ivy Zellman being accurate in a worst case scenario at 4%, locally, we could calculate that to be about home prices dropping 2%. So really, when you look at your change or what you're looking to do, every person's situation is different, but the most important part to better understand are the 3 things that we're covering today. Kicking off with number 1 is that mortgage rates are doing exactly what we needed them to do. They have to bring home price appreciation down. Remember, they're not rising rates to crash the economy or to bring the prices of homes down. They want to bring the rate of the homes appreciating down, and it's doing exactly what we needed. I don't like it. Nobody really should, but it is what we needed. Now, home prices, we have to look at, well, what is that impact then? And remember, we got to keep following supply and demand. And then most importantly, though, we have to start looking at the different markets that are going to be impacted. Because remember, this is nationally. every local market. And what an MSA is: a metro service area. So talk to your local expert. If you need help, I can connect you with the top 1% across the nation. But you could see here, they're saying there's about 618 major metros that they're following that they believe are going to see an increase, an appreciation of home price, whereas there are 257, all right, they're going to see depreciation. Now, here's the interesting part that Zillow is sharing here is they believe that the majority of all those market centers are going to see less than 1% to 3% depreciation, meaning the amount of value going down in the home is going to be less than 3% through 2023. That's a very little amount of depreciation compared to how much equity has been gained over the last year to 5 in home ownership equity. So now let's also look at, okay, well, what is the home price expectation survey saying? Remember, this is the group of the top 100 economists in America, and what they are saying is the exact same thing. We are going to see a lot of beliefs in these economists around when we take the top 100. What do they believe is going to happen? Is the majority of all of them believe we're going to see either no change or appreciation. In fact, the majority of them are thinking somewhere between 3 to 5% appreciation. So remember, we're going worst case scenario. 2, I'm hoping best case for everybody, but I want nobody to be surprised because there are some markets that will see depreciation due to the fact of the current way that their market has been responding to these changes. But let's dive even deeper to the home price expectation survey and what they're saying is going to happen from 2024 through 2026. So as you can see, earlier I was saying 86% of the economists believe we will see appreciation through 2024. 91% say appreciation through 2025, and almost 97% in 2026. So remember, real estate is a long-term investment, and so the get rich quick is probably not the right mentality or mindset to have. But if you're making a change for the benefit of enjoying your life more now and being able to do that for the next 3 to 5 years, you can see the outlook looks healthy. That's the goal. It's not necessarily that I'm right in my decisions. It's that I'm making smart decisions. And right now, when we really look at the next 3 to 5 years, making a change in real estate would be smart for your situation and timing it around what's best for you and market conditions support. But trying to time the market may lead you on the sidelines like many people continue to be. So I'll time out for a quick moment. And this is the part where, as a local market expert and real estate advisor, it's important to know what's your story. I want to share the news, not the good or the bad, but really the facts. Now, correlate it to worst case scenarios and best case scenarios because they are statistics. But what your story is what really matters. As you start looking at the equity being the shining star of the housing market, is that if you're a homeowner, you have time, patience, and really healthy market conditions over the next 3 to 5 years to make a change. If you're a renter, the challenge is that home values continue to rise, which also, as we start looking at long-term investment over the last 30 years, I'm going to show you the equity gained in housing, is that the downside is the years you don't get back in being a homeowner. And as you can see here to close out today, U.S. households own $41 trillion in owner-occupied real estate, just over $12 trillion in debt, and the remaining $30 trillion in equity. The national loan-to-value in Q2 was only 30%, the lowest since 1983. So what this is really sharing is that homeowners had an average of $320,000 in inflation-adjusted equity in their homes at the end of Q2, which is an all-time high. We know we'll be giving a little bit of that back, as we talked about, over the next 18 months in some markets. But as you start looking at the 3 to 5 year run during that time, the amount of equity gain will still be extremely high. And for many households, home equity is the only source of wealth creation because inflation has been so strong. As a result, recent records gains in equity and record declines in loan-to-value ratios will provide many homeowners with a financial buffer in case economic conditions worsen. What do we mean by this? Directly, what it is there will not be a foreclosure crisis because people have so much equity in their home, they can sell and walk away with a profit. And you can see here, just looking at the homeowner equity gains over just the last year, the national average 60,000. Now I know this is a quarter 2 report, and quarter 3 we know that number will decline a little bit due to the fact that some markets had an impact, but still the year over year will be a positive equity gain, which is also the name of real estate, paying down the loan and seeing over time appreciation benefit you in equity. But for those getting into the game for the first time, they don't get to experience what I mean by that, the game going from renting to owning. They don't really get to experience this, but they will over the next 10 to 30 years, because as you see, yes, we have all of these home equity increases through the report, and many of them being records, but the percent change in home prices since quarter 1 of 1991, you can see the national average was 300%, and in some very, very strong states all across the nation, specifically the West, is that we've seen an extreme amount of equity and percentage of change in the home prices, which is why for most people getting into the market now is a good thing if you're going to be in it long term. And if you're not currently in the market, meaning you're putting that money towards rent, which we know has done one thing since 1988, which is continue to go up. We may see rental prices plateau a little bit. We might see them even go down a little bit. However, the challenge is they would need to go down an extreme amount to ever see a long-term benefit in renting over owning. Now, I know for all of us, renting is a part of life. It's a part of period that we've all gone through, myself included, but the goal is eventually to stack up the years that you actually are in ownership and taking advantage of that cumulative equity like we shared in that slide of percent change in home prices since 1991. And remember, home ownership changes lives. You've got security and stability, privacy, personalization, and home improvements, meaning putting more money back into the home to see a higher level of equity gain, health benefits, financial education. You have more participation within where you live and your community. And as we look at all of these reasons, this is why I say your story matters. Is right now, it's not about making a decision right away. It's continuing to know the smart decisions as you spend time following the market. So thank you for giving me your time today. And as always, I'll continue to be that local market expert for you, both nationally and locally, and the unique perspective that I have of being a part of the top teams all across the world. So that way I can let you know the impacts that you're seeing in different places outside of just here in our home of Colorado.